Live from New York City this morning. Good morning to you all. About 20 seconds away from the opening bell. Equities positive here by 0.6% on the S&P. On the Nasdaq, absolutely flying. Big tech getting it done in a big way this week so far. The Nasdaq 100 positive by 1.2%. From New York City, the opening bell rings. Switch at the board and get to the bond market. Yields look like this on a 10-year. 10-year Treasury yields higher by 4 basis points, 349.20 on a 10-year. Dollar stronger, euro weaker, just about holding on to a 110 right now on a single currency. Crude positive 0.6%, 74.71 on WTI. Let's get straight to this session. 10 seconds in, positive 0.6% on the S&P. On the Nasdaq, positive almost 1 full percentage point. One stock to watch at the open around the tech story, it's Meta. Shares rallying on better than expected results. Mark Zuckerberg, the CEO, saying this: a stronger financial position will enable us to weather a volatile environment while remaining focused on our longer-term priorities. Ed Ludlow, we've got some growth.
Yeah, we've got some growth. The stock up more than 14%, which would be its best day since early February, and $77 billion of market cap added back to this name that had a really hard 2022, but has been resurgent so far year to date. It all started with that outlook for the fiscal second quarter, revenues of $29.5 to $32 billion. Even at the low end, that came in above street expectations. On the call, Mark Zuckerberg speaks for 6 minutes about AI and then 30 seconds about the metaverse. But actually, probably the star of the show was the CFO, Susan Li. A lot of emphasis on efficiency. You look at the expenses forecast. Again, it's been lowered from $92 billion for the year to $90 billion for the year. CapEx 30 to 32 billion. They're telling a story of how this is paying off, but they need to invest on an ongoing basis in the infrastructure to support AI. One point that's not really been discussed this morning, Jonathan, is about the ad market. So there's signs of strength, right? They're driving traffic to their platforms, but remember, we're lapping soft comps. What was happening this time a year ago, the war in Ukraine had started, which had a profound impact on the advertising industry. Lapping those soft comps makes the kind of near-term outlook a lot more attractive. But there is evidence that on the user base, from an ad engagement perspective, this is a company that's doing good at its bread and butter and is excited about AI.
What a move, approaching 240. Ed, thank you. Looking forward to the coverage from you and the team a little bit later. Meta, just working the Bloomberg for you, just quickly. Now the best performing stock of the year on the S&P 500. Facebook up close to 100% on the year. It was second to Nvidia. Knocks Nvidia off the top of the pile. Meta up by close to 98% year to date. This morning, up 13. The South Side weighing in on this in a major way, as you might expect. This is one of the analysts, the team at Piper Sandler, saying this, boosting the price target and saying the following: Meta successfully passed the baton from cost cuts to revenue re-acceleration. This is the really important point. The business is now operating better and executing faster with fewer employees. Following another impressive print, Meta remains our top pick in digital advertising. That's the team at Piper. That's the stock right there, up by close to 14%. Let's stick with the earnings. Want to get to another name. Shares of Southwest under pressure after reporting bigger than expected quarterly losses. An operational breakdown delaying December flights resulting in a $380 billion hit. Abby on top of the story this morning. Hey, Abby.
Hey, John. Well, yeah, and that 5% loss on the day, that's the worst day since the beginning of March. So investors not liking this, in fact, down for a third day in a row. And it has everything to do with that wider loss that you're talking about, a loss of 27 cents per share versus 22 cents. Earnings were roughly in line, but that December turmoil, if you recall, people stuck in airports, even one bride missing her wedding because of their faulty technology, that cost them $380 million. Now, relative to bookings, it also hit bookings in January and February for the reason that perhaps folks were nervous to get on one of their planes. Not surprisingly, John, this means that we do have the shares of Southwest Airlines underperforming other airlines year to date at a loss. The other airlines up a little bit, in particular United doing well. And I just want to throw in a little bit of breaking news related to transportation. Mobileye, the automobile software company, plunging down, had been down more than 30%. At that point, a record low. They cut their revenue outlook, and some are saying blame Tesla.
Abby, thank you. Southwest is down by close to 5%. Let's go to the industrials. This from Caterpillar, topping profit estimates, delivering some upbeat commentary too. The CEO saying this about 2023. 2023 will be better than we previously expected. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Caterpillar beat on profit and then some. Just to go through the numbers here, adjusted EPS came in at $4.91. Just for some context, the average analyst estimate was for $3.82. So a big beat there. And it was so good, actually, that analysts are worried it won't last, which might explain why shares are currently down about 4% or so. You had Baird in particular warning that Caterpillar's, quote, outstanding margins may not be sustainable. But regardless, the first quarter, at least, of 2023 was super strong. There had been question marks, of course, over construction demand, particularly in North America, which is Caterpillar's biggest segment. You can see, though, that year-over-year sales growth came in at 31.5% in North America, though, with volumes climbing for other regions as well. And that's good news, given that Caterpillar occupies this global bellwether for the economy.
Wall Street is a funny place sometimes. So good that maybe this is as good as it gets. The stock is lower by 3.7%. Katie, thank you. I want to turn to financials. One name has dominated the conversation. It's First Republic, looking to snap a two-day skid that wiped out more than 64% of its market cap. Bloomberg reporting the U.S. regulators are considering measures that would potentially curb the bank's access to the Fed's lending facilities. The stock this morning, Shonali, at least, positive for once.
Yeah, absolutely. That's after it had lost $1.9 billion worth of its market value in the 2 days alone, John. This is now a bank worth about $1 billion, trading at about 7% of its book value. So sorely beaten in the last couple of days alone. Now, where do we go from here? If you take a look here, what's interesting is if you think about First Republic selling all or parts of itself, if it were to sell loan books, what would people buy? Remember, this is a bank that is very heavily exposed to residential, commercial real estate. A lot of those residential loans were also interest only. We're hearing a lot of folks in the market are worried about being able to make money off these loans at the end. So then where does the FDIC fall in? If they are selling all or parts of the bank, what kind of assistance would the government be able to provide if we get to that point? Now, remember, the question is, if this were to continue on a downward trajectory, what is the end game? What is the contagion effect here? We have seen a lot of stemming of issues in the banking system, but the point at which you started at here, curbing access to potentially the Fed's borrowing facilities or FDIC's borrowing, you have an issue of capital when it comes to the banking system. Now, do other banks also face similar fallouts as well? I think that's what you are worried about at the end of the day, access to capital being constrained, as well as what is the broader ripple effect should this bank face more pain in the coming days.
Just turning negative as you and I talk. Shonali, thank you. It's just one of those names at the moment. You just keep up on the screen and just keep watching through the session all over the place, just about turning positive again on the day by about 1/3 of 1%. The broader market story, 7 minutes into the session, we're up by 0.7% here on the S&P 500, on the NASDAQ positive by more than 1% for good reason. Big tech so far, massive weightings of these indexes. Big tech so far doing big things. Microsoft, then Meta, Amazon a little bit later, one to watch. I want to talk about credit briefly. The banking fallout, keeping Invesco's Rob Waldner cautious on credit. Current spreads seem to compensate for potential risk, including recession and volatility in the banking sector. We favor higher quality investment grade corporate credit over high yield and bank loans. Rob, the risks of a global recession, how pronounced do you think those risks are this morning?
Well, John, I think we need to look at what we're actually seeing is that growth is coming out pretty good. We got GDP data today that was not fantastic, but it was pretty solid. Consumption was good. And we are seeing continuing momentum in the economy. So while recession is a risk, it's a risk for us. It's not the key. It's not an expected outcome. It's just a risk.
How does that stack up with what you're expecting in the Treasury market, Rob?
Well, the Treasury market is caught between the Fed and the disinflationary environment that we're in. So, John, I think we need to think about where we actually are, which is an environment with okay growth and disinflation in our view, versus what expectations might be out there for the Fed and what their forecasts are. And the Fed is keeping rates very high at the short end while we have disinflationary forces and slow growth keeping the long end down, and we're keeping this inversion. And the Treasury market's really caught in between those two. So medium term, great value is available now in the Treasury market. Real yields are some that we haven't seen for quite a long time, but for now we think we'll be a little bit in the range.
Bob Michael at JP Morgan was on this program yesterday, made the case for recession before the end of the year potentially, made the case for a rate cut by September, made the case, Rob, for the 2-year, the whole curve from 2s all the way out to 30s to drop to 3% and maybe threaten to break that level and have a 2 handle on Treasuries. 2s all the way out to 30. Rob, does that resonate with you at all?
So I think what can happen here towards the end of the year, Jonathan, that could get us into that kind of environment is that if inflation continues to come down as we expect and growth stays positive but not exciting, the Fed will get into what we'll start to call maintenance cuts, because as inflation comes down, real rates at the short end will get higher and higher if nominal rates stay unchanged. So as inflation comes down, we might start to see the Fed follow inflation down if they get some comfort that inflation will continue to come down, and that's what we expect.
So, Rob, that would be the call that would lead to a shift in the yield curve eventually. Rick Reed with BlackRock was thinking about some of these issues, and he said something interesting in yesterday's program. When we had a conversation about where to take yield, what pockets of the market, how much duration you want to take, he said we're in one of these really strange situations where if you give up cash yields and go further out along the curve, you give up yield. Now, Rob, that speaks to something you were talking about with the inversion of the yield curve. Rob, can you speak to that? What's the argument to go further out along the curve?
Well, the argument to go further out along the curve is that the Fed will pivot here at some point, and when it does, those overall rates will come down. I think that I would like to add into it a bit of a sort of credit spread conversation, because, you know, if you add in the credit spread that you can get in a sort of high quality corporate bond out the yield curve, you can get pretty good returns. So even, you know, year to date, investment grade credit is up 4%, I think, in total return terms. So that's beating cash very handily. So if you continue to get that kind of performance going forward, and what you really need there is stability in rates, spreads to stay stable, you can get some very good returns.
Stability in the banking sector would be nice as well. Big conversation this morning, Rob. I'd love your input on. Is there an argument for the Fed to pause as soon as next week?
Well, I think the Fed, we believe the Fed will pause next week. I doubt it's about the banking system will be the decider, though. I think it's becoming increasingly clear that these are idiosyncratic events that, you know, if you're running a levered book, which a bank essentially is, you need to make sure that your financing is very secure. And for First Republic, their financing was not secure. They've seen this big deposit outflow, and their overall cost of funding has increased dramatically. And so even leaving aside the asset side of the balance sheet, you need to make sure that your funding is secure. And if you don't have secure funding, when that funding either increases in cost or it becomes harder to get, then the problems on your asset side of the balance sheet come to the fore. But that is not all banks. So funding is secure in the system in aggregate.
Yeah.
It's just not secure for a few particular institutions. And I think that's the thing that we're missing. It's about the funding is causing issues in these banks, and the funding is not a problem for the system overall.
Rob, can I ask one final question?
Yeah.
SVB failed. Credit Suisse failed. Signature Bank failed. First Republic's facing some problems. Can I ask you this? How many banks would need to fail before it was no longer idiosyncratic?
Well, I think you'd need to see some sort of brewing trouble in some of the larger, the larger banks, probably before we got to that in the U.S. that were caused by these factors sort of building momentum, and we certainly don't see that.
Rob, it would have to go that far for you before you turn around and say, we got a big, broad issue here.
Well, so Jonathan, but it is about the funding of. So the question I think you asked me is it systemic? And for the system as a whole, funding I think is quite secure. If you continue to get a lot of stress in regional banks, would it cause some issues in certain sectors of the economy, such as real estate, some local small and medium-sized enterprises? But those are certainly headwinds that we could see in the economy resulting from this. But I think we need to differentiate between the sort of systemic issue and, an impact on growth. And that's what I'm trying to do.
Got it. Understood. Rob, thanks for your time, sir. As always, Rob Waldner there on the latest in this market and the banking issues as well, and the Federal Reserve next week. A lot to get through. About 14 minutes into the session, up by 0.6% on the S&P. The Nasdaq doing nicely. Coming up, the debt debate heating up.
The Senate could pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy in conversation with AMH down in Washington, D.C. a little bit later on this afternoon. We'll catch up with Anne-Marie next.
Now he should sit down and negotiate. We passed this early. We are in April, way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate can pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy, his debt limit bill passed in the House, kicking off what is likely to be a long standoff between the two parties as lawmakers call on President Biden to come to the table.
Happy to meet with McCarthy, but not on whether or not the debt limit gets extended. That's not negotiable.
Bloomberg's Anne-Marie joins us now from Washington, D.C. AMH, do you get the sense the president's coming to the table anytime soon?
Well, what's interesting about the president's comments yesterday, you know, this was a speech about really foreign policy. He's standing there next to the South Korean President Yoon, but he didn't mention the budget. He didn't say the Republicans still haven't addressed a budget. What he said was we need to make sure that default is off the table. So potentially there's a little bit of an inching, Jonathan, towards some sort of meeting of the minds, at least, of that these two individuals can get in a room. Remember, one of Speaker McCarthy's biggest gripes right now at the White House is that they not have had another conversation since February 1st. What he was able to do yesterday was really a political victory. It's the start of this debt debacle, though. We should not think that we're anywhere near this getting over with in Washington. He was able to coalesce moderate Republicans, far-right Republicans around his bill with one vote on the floor. And really what he's saying now is we were able to pass a bill that does raise the debt ceiling. Obviously, there's a lot of fiscal cuts in that the White House does not want to see. It's dead on arrival in the Senate. But really, it's an opening moment for the White House to start to potentially say, okay, we're going to have to negotiate. But the Republicans were able to get a vote on the floor, and it was able to pass.
There were tons of doubts about him getting it done. We were talking about this. Yeah. Never mind asking the president to negotiate. He had to negotiate with his own party. Gets it through. Anne-Marie, you're going to catch up with Speaker McCarthy a little bit later. I think it airs at about 5 p.m. Eastern Time on Balance of Power with Joe Matthew. I'm really looking forward to this conversation. What are you looking at getting at with Speaker McCarthy later?
I think one really key point in this debt debate for the speaker and what's going to make his job much harder is you saw how hard it was for him to get Republicans to coalesce around this bill. If he is able to negotiate with the president, so many provisions in this bill, Jonathan, are never going to fly with the Democrats. So at some point, if he is going to be able to negotiate with the president, he's going to have a much weaker bill that then he will need to get through the House. And I think that's where it's going to be much harder for him to get the likes of the Freedom Caucus on board. And he has such a slim majority, he can only lose 4 votes. So that is when it's going to become very tricky for him. Yes, he had a political victory yesterday, but now it just gets harder.
AMH, thank you. Down in Washington, looking forward to the conversation a little bit later. Another story out of D.C. this morning. Take a listen to this. Federal Reserve Chairman Jay Powell held a call with a pair of Russian pranksters posing as the Ukrainian president. This according to video that's been shown on Russian state television. The Federal Reserve put out this statement. Chair Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president. Fed spokesperson went on to say it was a friendly conversation and took place in a context of our standing in support of the Ukrainian people in the challenging time. No sensitive or confidential information was discussed. Mike McKee, I want to bring you in on this. Also important to point out that the Fed also said the video appears to have been edited. Can't confirm it is accurate. Mike, your response to this as this story continues to develop?
Well, there are a couple of things. One is, did Powell discuss anything that he shouldn't have discussed with someone who wasn't the head of state? The Fed says no. I guess we take them at their word for now, but I'm sure the Inspector General would like to ask some questions about that. The other is, how did they get through to Jay Powell? Now, apparently this duo in Russia has done the same thing with a number of other people, including ECB President Christine Lagarde and former German Chancellor Angela Merkel. So they have some way of getting past the guard posts and getting to these policymakers. The issue will be how do they do it, and how do you stop it in the future? Does this rise to the level of a real problem for the Fed? I'm not sure it does, but it could if there was something else to it to happen. One thing to keep in mind too is this took place in January, so anything Powell was talking about then probably doesn't matter now.
Well, I think that's part of the story, actually, Mike. what have we only just found out? Was the Federal Reserve aware in January that this was a prank, or only became aware overnight that it was a prank?
That we don't know. We don't know when the Fed found out. I mean, this only just aired on Russian TV, so obviously there was some significant delay here. And again, we don't know what Powell actually said. As you mentioned, the tape edited and it's all dubbed in Russian. But it is an interesting situation.
Amazing. What a story. Mike McKee, thank you. A story we'll stay on top of. Just to repeat, the Federal Reserve saying the video appears to have been edited. Can't confirm it is accurate, but acknowledging that Chairman Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president, according to a Fed spokesperson. Overnight, just unbelievable. The broader equity market looks like this on the S&P about 23 minutes into the session, positive by 0.8%. On the Nasdaq, up by more than 1%. A lot of big tech earnings. They continue. Apple next week, Amazon after the close. Your trading diary up next. 26 minutes into the session, doing nicely. So far, so good. Up by 0.8% on the S&P. On the Nasdaq, positive by 1.27%. Meta flying. Let's get into the trading diary. Coming up a little bit later, Amazon, Intel, Snap reporting after the close. PCE, inflation data, UMITS, consumer sentiment, personal income and spending numbers Friday. Plus, the Fed publishing its review on Silicon Valley Bank, all leading up to the Fed's latest rate decision next Wednesday, followed by Apple results the following day. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, April 27th. Here are the top market stories we are following for you at this hour. Searching for demand destruction, GDP data shows companies are pulling back on inventories, but consumers are still resilient. Earnings suggest that's true as well. We'll get a read on travel spending from the CEO of Hertz this hour. Searching for a rescue, First Republic is stuck in a standoff between the U.S. government and banking industry as neither rushes to help it survive. What happens if it's left to fail? And searching for opportunity. How do you invest in credit through a banking crisis and a possible recession? Blackstone's Dwight Scott joins us to discuss. From Washington, D.C., I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, we've had a lot of economic data already that, according to one investor, is the worst of both worlds, and we have more data crossing the wire right now.
Yeah, yesterday we actually saw some fairly strong housing data. Today we get the exact opposite. We get some weaker than anticipated data. Pending home sales month on month, negative 5.2. That's down from plus 0.8. The market wasn't expecting it to be this bad. That takes the non-seasonally adjusted year-on-year number to negative 23.3. So the housing market is still, I would argue, choppy. But it's going to be interesting to see how the data works over the next few months, because the new home sales, the pending kind of elements of some of this stuff looks okay. The pending home sales data we get today looks a little bit weaker. Are we settling out? I actually want to rewind a little bit, Kaylee, to the earlier data, which I think is certainly much more consequential right now. You've got the GDP number today, I think maybe misrepresenting the economy. The headline number shows weakness, but you dig below the surface. You've got a consumer that is still strong. You take a look at what is happening with MasterCard as well. You've got inflation that is still fairly punchy, but you've got U.S. companies that are reducing investments and they're running down inventories. And I do wonder whether that's going to be a problem in the latter part of the year.
Yeah, it's a really good point, because remember, we got into the whole inflationary crisis to begin with because we had too much demand and not enough supply. That was a product of pandemic-era supply chain disruptions. Now, if companies are anticipating a downturn, so constraining supply once again, but the demand still is there, does that risk us just refueling that and repeating this episode all over again?
Absolutely. And I think it's really interesting to look through the corporate earnings that we're getting at the moment and take a look at what is happening here. You look at the travel companies. We're going to talk to Hertz later on. They are super pumped about the demand they're seeing. What is going to happen this summer? Does it continue? You take a look at the consumer goods companies. They continue to see very strong demand. Now, it's not consistent across the board, but demand is holding up. And some companies clearly on the inventory front are getting this wrong. So our question of the day, Kaylee, is are companies still underestimating demand? Are the data misrepresenting this economy? Joining us now, Bloomberg's Mike McKee and Kriti Gupta. Mike, let me come to you first of all. Does this data misrepresent an economy that looks good? And why are companies getting it wrong? They're running down inventory at a time when actually the consumer is still strong.
It's an interesting question, because we've had nothing but talk about recession from people on Wall Street on this television network and others. So maybe they were anticipating something along those lines. Business spending dropped significantly. Does this mean that we're going to see a rebound in the second quarter as businesses try to keep up with demand? Well, for that, you have to look at what's going on with personal consumption. We saw a big increase in the quarter, 3.7%. But almost all of that was in January. Tomorrow we get the numbers for March, and they're expected to show contraction for the month. So if consumers are really slowing down, then does business come back with more inventories or not? Since the inventories were negative, you're probably going to get a rebound, but how strong? That's the question.
Well, and if we do get a rebound, Mike, does that just mean that if the Fed pauses after this upcoming meeting, as everyone is expecting, that actually they could hike next, not cut?
Well, they could. That'll depend on the inflation numbers. We do get new inflation PCE numbers, their indicator tomorrow. And if it comes in stronger than expected, that'll raise a question in traders' minds about what they'll do next. But we also get the employment cost index, which should give us some information about the way wages and salaries are going. In the first quarter, we're going to see a bump in compensation because of the Social Security COLAs that took effect. But wages and salaries, are they starting to come down at all? That's going to be a real question for the Fed as they look at the inflation numbers.
Crudy, are we being unfair to U.S. companies here? I take a look at the numbers. We talked to PepsiCo earlier this week. I take a look at the MasterCard numbers today. They're very strong. We're going to talk to Hertz a little bit later on. Those numbers look super strong as well. Are U.S. companies actually getting the consumer about right and are riding a really a sort of strong wave here that is driving some decent top-line gains?
Well, this isn't about the consumer at all, and I think this is where what you're seeing on the surface completely mismatches what you're seeing on the economic data, because look underneath the hood, Guy, yes, on the top line, you are seeing some major beats, you are seeing margins increase, you are still seeing a consumer that is able to weather the storm, but a lot of the company gains, the company profits, are a function of price hikes or cost efficiency or layoffs, or in some cases even buybacks, and that's really what is holding up those earnings, and then they are being lauded for it because, yes, the companies or the corporate America, as Lace has done a good job in holding up in this environment, but then look underneath the hood, and I'll give you a great example that we're seeing today. Caterpillar came out with earnings, this global bellwether. They make construction equipment and tilling equipment for customers around the world. They have that China exposure as well, about 23% of it, and yet the stock is down despite the fact that they reported their profits are surging on that machinery. Now, on the top line, things look great. So what is the problem here? Yet you're seeing the stock actually drop, and the reason for that is because the backlog hasn't actually changed, which tells you that even though on the top line, or excuse me, on the bottom line, the margins are increasing, the profits have surged for Caterpillar, so they're doing a good job in terms of weathering the storm. When you look at the actual demand story, that hasn't changed. The backlog hasn't changed at all, and that's what those shares are getting punished for, which I think is a great little micro ecosystem for what you're seeing in the broader economy. Corporate America is able to weather the storm in the way the economy isn't.
Well, and Crudy, I look at a stock like Meta today, up 14% after its earnings because the ad rebound was better than expected, enabled it to beat expectations. Wouldn't that suggest that advertisers are seeing robust consumer demand and therefore spending accordingly? Is this more evidence of the dynamic that Guy and I were just talking about?
It is and it isn't. Look, the advertising spend gets tricky when you look at some of these social media companies. I'm going to put Alphabet kind of aside for a second because they have their own thing going on with cloud and AI. But for Meta specifically, when you look at advertising spend for any social media company, traditionally more advertising, to your point, Kaylee, means a stronger consumer. They're trying to rate that demand. It also works in the opposite direction. If you are seeing a finite amount or some sort of element of scarcity in terms of how much the consumer can spend, there is going to be increased competition to get that last dollar. And I think that's more of what you're going to see from Meta. It kind of fits into this recessionary standpoint because at the end of the day, Meta is still talking about cost cuts. They are still talking about the year of efficiency that Mark Zuckerberg talked about at the start of the year. And they are still really hesitant in terms of their AI push. Yes, they're making AI investments, but it's not as strong as some of their peers. So take it with a grain of salt.
Mike, final point to you. How will the Fed read today's data?
They're going to be looking at the most recent aspects of the data. They know January was strong. They reacted to that at their February meeting now and at their March meeting. Now they go into the May meeting with what appears to be a slowing economy. And does that continue? If the consumer is slowing, if business spending isn't picking up, then do they think they have done enough? That'll also encompass the inflation numbers. But I don't think they look at the top line number here or even the consumer spending number in this GDP report and say it shows them anything they aren't already expecting.
Well, and of course, they have to factor in what's happening in the banking system as well as we all watch First Republic too. Bloomberg's Michael McKee and Kriti Gupta, thank you both so very much for joining us. And coming up, we're going to get more insight into our question of the day. Are companies still underestimating demand? We'll get an answer from Kara Murphy, Kestra Holdings CIO, who joins us next. This is Bloomberg.
season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think the Credit Suisse was a very specific case. While I think Silicon Valley Bank was a specific case in terms of its circumstances, it has highlighted an issue with some of the regional banks in the US. And that we will see continuing to play out maybe in a small number of names. And we've seen First Republic over the last couple of days. So I expect that we will see over a small number of names. It's not going to be systemic in any way, but there will be repercussions.
That was the Barclays CEO speaking exclusively to Bloomberg's Francine Lacqua earlier today as this market contends with a lot of economic questions. How healthy is the banking system on the one hand? What does that mean for lending and a possible credit crunch? On the other hand, a consumer that still seems to be spending quite a lot with businesses pulling back their inventories, which brings us to our question of the day. Are companies still underestimating demand? Joining us now is Kara Murphy. She is the CIO of Kestra Holdings. Kara, how wrong are we getting it? Companies, the Federal Reserve maybe even?
Well, for sure, we're seeing a lot more strength in this earnings season than what we had expected just a couple of weeks ago. Let's not forget, though, that earnings estimates have come down quite significantly heading into this event. So while we are seeing companies beating, we are seeing inventories a little bit lower than probably where they should be. This is all on the back of a decelerating trend in earnings. Now, that said, I think what we're seeing is that there's this kind of gear shifting in the economy, and certain areas are slowing, other areas are remaining very resilient. And on that side is consumer. And consumer has stayed very strong, both in terms of spending. You know, housing is looking good. Labor market still remains strong. And that continues to power forward this economy.
Is there a danger that companies front run a consumer slowdown too aggressively, Cara? I look at the inventory data in the GDP numbers today. Inventories have come down really sharply. Is there a danger that certain goods companies may find themselves in a position where they're now struggling to keep up?
For sure, and I think this is a real conundrum for the Fed. This is not the outcome that they want, right? Because lower inventories with strong demand translates to higher prices, not lower prices. And usually the Fed gets what they want eventually. And so what that means is that they're going to have to pull harder on final demand in order to get that, demand and inventory to right size itself. But for right now, it's not where the Fed wants it to be.
So on the subject of the Fed, Kara, when this market is still betting that we're going to see it turn around and start cutting rates by the end of this year, how misguided is that?
I think that's the biggest question mark going forward. The market seems to have coalesced around this idea that we have one more Fed rate hike, but then where there's a huge divergence is in the second half of the year, where I was just looking at the futures numbers this morning. We're still forecasting a significant deceleration in the Fed funds rate in the second half of the year. The Fed is still saying that that's not going to happen. So I think what the Fed is going to have to do at the next meeting, as they raise that quarter point, they are going to have to start to talk those forward expectations up. Because generally speaking, the Fed doesn't start cutting rates until there's some sort of crisis or really evident need to be able to do so. And so they're going to have to start talking those rates up in order to stabilize things.
Cara, why are we getting the consumer wrong? And I appreciate that some of the data within the GDP number today was quite backward-looking. It dates back to January. But then I look at the MasterCard numbers today as well, and they're more current, and they're telling me that the consumer is still alive and kicking. And I'm wondering why we continue to underestimate the consumer. What is it that we're getting wrong, do you think?
I think ultimately you look back at the labor market. We still have among the tightest labor market that we have had in generations. Wage growth remains above 6%. People feel very confident in their jobs, and that is really driving that spending. Throw on top of that, compare today's situation versus a year ago when gas prices were high and accelerating. Gas prices have come down. Those tend to have a really big impact on incremental consumer spending. So between those two, consumers are looking around and saying, I still feel pretty good.
Okay, so if the consumer is feeling good, how good should investors feel? Because we've had a lot of talk in recent weeks about how tech, for example, was getting overextended. It was becoming too expensive once again, yet the earnings for tech are looking pretty good, and the economic data isn't necessarily painting too dire a picture, at least in terms of the consumer. So what's the investment thesis here?
I think here, when we look at valuations, right, so we have earnings that are clearly decelerating but not falling off of a cliff. The challenge is that valuations are about average or above average. So what that tells us is the market is betting that whatever deceleration we see in earnings is going to be quickly sort of round-tripped, and that we'll see growth either in the back half of the year or early 2024. So you have to believe that in order to believe that the market continues higher from here. We're a little bit more cautious because we think that the Fed is not going to start cutting rates aggressively in the second half of this year, and so we would be a little bit more cautious. We wouldn't head for the hills completely, and then I'll add two other things. One is that the debt ceiling negotiations are really going to start heating up, so headlines are going to be tough in the next couple of months. And then you also start to get seasonal tailwinds turn into headwinds.
Cara, the one story we're not talking about today is First Republic. Is the banking crisis nearly over?
That's a very good question. I mean, it's been interesting looking at these banks report earnings through this season. You had the big banks that were basically cleaning up. I mean, you had some of those companies report the best quarters that they've seen in quite a long time. And then meanwhile, some whose, viability is still being questioned. So I don't think it's completely over, but I think the chance of it sort of like bleeding out into a broader systemic crisis has ebbed. And that's a good thing. The Fed has contained it to a small number of names. Now, the implication of that is that, it may not suck up the whole banking system, but banks are going to be more cautious going forward. And with that, credit is going to come down, and we're already starting to see tightening standards increase, particularly for small businesses. And that, again, is a drag on economic growth.
So would you be using the phrase credit crunch at this point, or are we heading there?
I think we are heading there. And again, it's not some massive seismic change. It's simply banks kind of doing the smart thing and reining in credit. So you have higher rates, which is the challenge, and then you have credit harder to come by. So those two things ultimately lead to less credit available. Yep. And a credit crunch sort of, has this sort of negative, ominous tone to it. But that's really what we should be seeing at this point in the cycle.
Cara, great to catch up. Always a pleasure. Thank you very much indeed for your time. Cara Murphy, Castor Investment Management, CIO. Still ahead, Meta going from strength to strength to strength. Meta's digital ad rebound, setting the stocks surging once again. Its year-to-date performance is absolutely epic. Will this positive news continue? Are we going to see a continuation in the likes of Amazon? We've got Snap, we've got Intel still to come as well. We're going to find out next. We're going to take you to San Francisco. It's time for the startup. This is Bloomberg.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Simone Foxman. American Airlines says expect a strong summer travel season. The carrier said its profit in the second quarter is likely to beat analyst forecasts, with international demand booming as domestic growth wanes. This tracks with what we've heard from American's rivals. United said global travel is expanding at twice the rate of domestic, and Delta will offer 20% more seats on international flights than it did a year ago. Meanwhile, that operations breakdown that disrupted Southwest Airlines flights in December, well, it's still hurting the carrier. Southwest reported a worse than expected loss in the first quarter. Those late year problems caused the airline to cancel more than 16,000 flights. Meanwhile, CEO Bob Jordan says demand for domestic air travel remains strong. Economic weakness around the world hasn't hurt the demand for heavy equipment. Caterpillar posted first quarter profit that beat estimates. The company's machines are critical to the construction, mining, and energy industries, and Caterpillar is viewed as a bellwether for the global economy. And that's your Bloomberg Business Flash. Kaylee.
All right, Simone, thank you very much. Well, it is now about 23 minutes past 7 on the West Coast, so let's get to the startup where we covered the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. And Ed, we have to start with Meta because this move is remarkable, up 14% on the day, now basically doubled year to date.
Yeah.
Is this an AI story? Is this an ad story? What is it?
There's a lot that investors liked, right? It's astonishing. Biggest gain since early February, stock at highest level since February 2nd, 2022, 100% gain year to date. The story's really changed, but it matches the change in narrative from Zuckerberg. The first 6 minutes of his opening remarks on the earnings call were all about AI. He spent about 30 seconds discussing the metaverse. It shows you how we've shifted. But I would say that, think about how earnings played out in real time. That second quarter revenue outlook of $29.5 billion to $32 billion, even at the low end of the range, that was above what the street was expecting. And so there's a really positive narrative around the core business on ads, how they're faring in a macro environment, but the cost discipline so key.
They're still spending a lot of money on Meta, though. We were joking just before we came on air. Are they going to rename the company AI? Because that seems to be the new focus of attention, the new shiny thing that Meta is talking about. What happens in terms of its spending? What happens with spending on the metaverse if this is the new reality?
It's a really good point. I blogged on the Top Live blog in the moment that actually it was a really mixed bag of results if you go line by line. So, expenses for the year have been brought down again from $92 billion to $90 billion. But if you look at Facebook Reality Labs, that unit that was driving the transition to the metaverse, its top line was half what the street was expecting. It had a wider than expected loss or, negative operating income. And the commentary from Meta was really clear that Facebook Reality Labs unit is going to continue to have growing losses. So they're clearly committed to funding that. And at the same time, the narrative around AI is also very clear. From both Zuckerberg and the CFO, Susan Lee, they're going to have to invest in the infrastructure for the compute from a data center perspective to support that growth in AI, which, essentially is quite nascent when it comes to Meta integrating it into its consumer-facing products.
Ed, just quickly, we only have 30 seconds left, but Amazon due after the bell today. What's the number one thing you're looking for?
All about the cloud, AWS. There are quarters where AWS accounts for all of Amazon's overall operating income. Microsoft and Google have shown some cloud strength, some resiliency. Does that apply to Amazon? That's going to be a really big question for them.
Amazon in the cloud. We'll look for that a little later. Ed, we'll look forward to some great coverage as well coming up. Ed Ludlow. Ed's going to join us in the next hour as well. He's got an interview with Bobby Kotick, Activision Blizzard's CEO. He's a little ticked off right now. We're going to go through the details. Coming up, we're going to put our question of the day. Does the banking crisis end with First Republic? To Dwight Scott, Blackstone Global Head of Credit. Joining us next, this is Bloomberg.
We are about an hour into the U.S. trading session. Stocks are up, but bond yields are too. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, it's about the economic data and the earnings.
Yeah, well, we certainly have a risk-on day, and it is, I would argue, largely about the earnings. One in particular, Meta, up 14%, its best day since early February. And of course, you have to remember this stock on the year going into yesterday's blowout report already up 80%. So today's big move sort of shadowed by what's already been going on this year, but helping out the S&P 500, the NASDAQ 100 more. Again, a blowout quarter from Meta. They raised the 2Q second quarter revenue guide, and they're also emphasizing AI, but they're saying that AI and metaverse are going to somehow merge. Where we don't have strength, let's take a look at the SOX, because the SOX is actually one of the only indexes down on the day, down 1%. Wolfspeed really weighing, down 14.5%, but most stocks in this index are down. And there's something I want to point out. Now, I really like a pretty chart. Ugly charts I'm not a fan of, but we have a very ugly chart here, but it has an important message. So for that reason, we're going to show it. This is the SOX, and this is the massive rally out of the October lows, the uptrend up and away. But more recently, we've been breaking that uptrend. Today, we're below the 100-day moving average. We're below the 50-day moving average. That's a fancy way of saying that those near and medium-term buyers, they're not so sure that they want to be in chip stocks. That's important because, of course, chips and everything that we use, so it could be a leading tell on perhaps the economic weakness that everybody's looking for, the recession, most predicted recession that has not happened. Maybe the SOX is saying there is some weakness ahead. And then finally, some other movers on the day, laggards as well from earnings. Align Technology, the Invisalign maker, case volumes down. Southwest down 5.6%. The turmoil in December really weighing on their results. Bookings apparently a little bit better in March, though, at least. And then Vornado Realty Trust down 1.4%. They have suspended their dividend for the year, and Piper Sandler did downgrade these shares to an underweight. And I should mention, Guy, that apparently 2% of Vornado's revenue is from Bloomberg LP, but well off the lows earlier today, down more than 10%.
Abigail, great stuff. Thank you very much indeed. Important to make those points. Abigail Doolittle, what's happening in the markets. Let's pick up and ask one of the questions that I think is floating around. In some ways, today is interesting because of what we're not talking about. We're not talking about First Republic in the way that we were over the last few days. Is the crisis over? Is there anticipation that this is ultimately going to be potentially coming to an end very soon, and maybe the banking crisis ends with whatever happens to First Republic? We need to get an answer to this. Basically, does the banking crisis end with First Republic? Joining us now to kick this around and kick around what is happening in credit land, Dwight Scott, Blackstone Global Head of Credit. And we're joined as well by Bloomberg's Wall Street correspondent, Sonali Basak. Sonali, I'm going to hand things over to you.
Thank you, Guy. Dwight, thank you for joining us, because when we look at First Republic, there's a lot of questions in the market of, does it end here, or is there a second leg to this banking crisis? What do you see out there?
Well, I don't think we know the answer to whether the crisis will see another victim down the road. I do think that we've learned that the market, and the Fed especially, is going to protect the banking market, and I think that will calm the market over time. There are a lot of strong banks out there. They are continuing to lend into the market, so I don't expect that we're going to see a continuation of a crisis for a long time.
You think about what happened with PacWest being able to really secure some credit. You see other firms look to folks like you. We had reported that you had paired up with Valley to try to buy SVB assets. How do you think about your role here? Are there opportunities for you to step in at scale to provide credit to the regional banking system?
Yeah. Well, our role in the banking crisis, in any other situation, is to look for good opportunities to invest our capital in companies, businesses, receivables, financial assets. And I do think we'll see opportunities out of the banking world, but most importantly, we're seeing just amazing opportunities out of the corporate world. Our corporate finance business has grown dramatically. We are seeing rates are at all-time highs. LIBOR is now above 5%. It was 0% 2 years ago. The average return on a private credit deal today is above 12%. That was 7% just a couple of years ago. So the return profile for a lot of what we do looks uniquely attractive right now.
So it sounds like, Dwight, that you feel that you're getting compensated correctly right now, maybe even maybe you're getting compensated very well for the risk that you're taking. But a lot of questions that we get asked sort of center around the idea that when I'm getting 4% on a US 2-year, when I'm getting the money that I'm getting in cash right now, why do I want to take credit risk? The numbers you're talking about sound very high, but does the risk compensate?
Yeah, I do believe the risk compensates. And by the way, I never feel like we're being overcompensated. I want to make sure I address that comment you made. We are trying to provide capital to a market that has been, since the summer of last year, the liquid markets have been effectively shut down for new issue. And so the private markets have been able to step in and provide that capital. And we do that with, I think, in a protected way. That has been driving investors into our business. So if you think about being senior secured direct lending kind of investments that we do a lot of, those will be highly protected in a market that everyone is worried about where the economy is going. And so not only is the return driving people into our space, but I think the protected nature and less volatile nature of a lot of what we do is going to drive capital our way.
But do you think risks in private credit markets are accurately being reflected, or are they still being masked?
I don't think they're being masked. So we're coming off of, in the high yield and loan markets, about a 2% default rate over the last 12 months. That remains below the historical average default rate of around 3%. And to give you some context, the default rate spiked up to like 12, 14% in the great financial crisis. So put all those things in context. Right now, if you look at loans in high yield, about 9% of those markets trade at default levels. Historically, that would result in about a 3% default rate over the next 12 months. So we actually feel like the market's pretty stable. Loan debt to EBITDA in the fourth quarter was down to below 4%. Coverage, so debt coverage of interest coverage was up above, approaching 5%. So the market is healthy, and that, by the way, that debt to EBITDA level is the lowest it's been since 2018. So the market's strong, and therefore I don't think we're going to see as much disruption as many people are worried about in the market.
Right, with that said, what won't you touch? With that said, a lot of people do believe that there could be worse economic times ahead, a potential recession. What do you have to do to avoid getting into any losses in that environment?
Well, we are fortunate that we don't have to buy the index. We can choose sectors, we can choose different companies, we can choose to be larger instead of smaller in the deals we're doing. And so I'll tell you what we have been doing. We like software, we like healthcare, we like business services, because those businesses tend to be more resilient in a challenging economic environment. We like larger companies. They have lower default rates, better recoveries if there is a default, and so we can play the market. And if you look at what's happening in the loan market, for instance, it's really interesting. The average loan trades today at about 94 cents on the dollar. The double B loans trade at 99. The single B trades at 95, and the triple C loans trade at 75. So there's great dispersion in the market, and you can stay away from some of those names that you don't like, that you think a default is coming, and concentrate on higher quality names.
Dwight, a lot of people are surprised at what is happening with spreads. You just run through the numbers. Many people expect, given where we are and where they think we are in an economic cycle, those spreads should be wider. Are you surprised as to where market pricing is at the moment?
A little. I would say that what we're seeing in the market today is the attraction of the overall return is offsetting somewhat a concern about spreads being too tight. So you'll see a lot of focus on the fact that if we start to see the Fed soften its stance, we start to see rates come off, you might see a widening of spread there as opposed to a full recovery in the pricing of fixed income instruments. So I am a little surprised that we haven't seen more spread widening, but the absolute return, so high yields, almost 9% absolute return right now, the loan market's 9.5%. I think that absolute return is attracting investors despite the spread being relatively tight.
Dwight, I'm sitting here in Washington where basically the only thing we have thought about for weeks is the debate over the debt ceiling and whether or not it will be lifted in time to avoid a default or avoid getting close enough to the X date that we could see a downgrade like we did in 2011. How are you thinking about that? Should markets be more concerned than they are in terms of how it can affect markets broadly, but also your world?
Well, I do think a lot about 2011. We all remember how disrupted the market was in the summer of 2011 when the U.S. was downgraded. And especially I think about that because right now I look at the credit markets, the public credit markets especially, as sitting on the fence. It is literally sitting on the fence. Bad news causes the market to kind of shut down a little bit. Good news causes the market to want to open up. If you look at what happened happened with the banks a couple of weeks ago, the beginning of the banking crisis, if you will. The market started to trade off and then quickly recovered and settled in at down a point. So yes, I am worried that if we get into a very bad news cycle with concern about what's going to happen on the debt ceiling, that would put pressure on the markets. And once again, this liquid markets and credit are trying to open up right now, and that pressure would probably be enough to push them back down and have them, not take new transactions. That would be good for our private credit business, of course, because we can finance those transactions, but it wouldn't be good for the market.
You know, you did the math a little earlier from the B's to the C's and what they were trading at, and I'm wondering also, you see how quickly things have gone from safe to risky. You think about the banks alone. Safe banks are junk tomorrow sometimes with the speed at which we're seeing downgrades. Why take on credit risk in this market of all the risks you're able to take on?
Well, I think of credit risk as a better risk to take on in an uncertain and volatile market than equity risk, for example. So credit risk exists across the portfolio. Let's go back to the great financial crisis. The high yield market had default rates, or the loan market had default rates of 14%. Recoveries were closer to 60%. So the net losses were relatively low. And if you think about the equity markets in that period of time, it took forever for the equity market to recover the losses that occurred during that period. So I think of credit as defensive. I don't think of it as taking credit risk. Now, there is risk in credit. I don't mean to say there's not. And I do think default rates will move from this very low level that they're at today to a higher level over the next couple of years. Traditionally, when the Fed starts to soften its stance, it takes 12 to 18 months for the default rate to really hit its height.
All right, Dwight, we have to leave it there, but thank you so much for joining us. Really insightful to get your take on things. Dwight Scott, Blackstone Global Head of Credit, as well as Bloomberg Sonali Vasek. Thank you both so very much.
Thank
now,
you.
Coming up, we're going to turn back to the earnings story. Rental car giant Hertz is riding a rebound in travel. We'll talk to the CEO, Stephen Scher, next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Simone Foxman. The U.S. economy slowed by more than expected in the first 3 months of the year. Gross domestic product rose at a 1.1% annualized rate, thanks to the strongest consumer spending in nearly 2 years. It was held back, however, by lackluster business investment and a pullback in inventories. The founder of a defunct blood testing startup, Theranos, will stay out of prison a little longer. Elizabeth Holmes was set to begin her 11-year term for wire fraud today, but a federal appeals court put her surrender date on hold until it can rule on Holmes' request to remain free while she fights her conviction. Turkey's health minister said President Recep Tayyip Erdogan will resume his election campaign, quote, very soon, and that he's on the mend from gastroenteritis. This after Erdogan postponed a video appearance on Thursday. He fell ill during a live TV interview earlier this week. Erdogan's trying to convince voters he deserves to remain in power despite a cost of living crisis and accusations that his government was slow to respond to devastating earthquakes in February. Global news, 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman, and this is Bloomberg. Kaylee.
Simone, thank you. Well, Hertz beat estimates for the first quarter thanks to strong travel demand. The CEO is predicting a strong summer season as well. And this gets us back to our question of the day. Are companies still underestimating demand? Joining us now is Stephen Scher. He is the CEO of Hertz. So let's talk about your company specifically and the demand that you are seeing, Stephen. How strong is it?
So demand is strong. I mean, we had strong demand in the first quarter. We saw within the quarter demand grow. February stronger than January, March stronger than February. So our exit velocity into the second quarter is strong, and we're now obviously a month into the second quarter, and demand persists. And so we're seeing it all across. We're seeing it in leisure. We're seeing it in corporate. We're seeing it in the rideshare business where we rent cars to Uber and Lyft and other drivers. And I would say lastly, you know, the area for continued improvement where we expect demand growth at very attractive margins are international travelers coming to the United States. Latin America has been back. Europe continues to grow, but I think there's real growth potential from a very low base in the context of Asian travelers, Japan, Korea, China, returning to the United States.
So what you're saying, Stephen, good morning, it's Guy in London, is that this demand is sustainable?
Well, as far as we see it, the demand is sustainable. I mean, I know we all are looking for indications where, in fact, demand may be softening. But as far as the travel industry is seeing, whether you've listened to the earnings calls of the airlines, the hotels, and now Hertz, you know, demand persists, and there's no indicator of it softening. Having said that, and from my days back at Goldman Sachs, I'm about risk management. And so you can't help but plan and think about the risk of there being softness, and we are prepared for that. But equally, you know, staring into a summer that I think will prove to be quite strong, we're ready to capture that opportunity in a very significant way.
What are you seeing in corporate travel specifically? Because leisure travel obviously is a different beast.
Yeah, leisure travel has been strong. Corporate travel has been coming back. You know, I think there's an interesting aspect to the corporate travel with kind of dovetails with a bit of the headline out of the GDP number today, which is I think corporations are reluctant to make major capital investments, and you saw that in some of the underlying factors to the GDP number. But their sales forces are out in force, and they are out spending time with customers. That's a good thing for the travel industry because they're renting cars and flying on planes and staying in hotels. And I think that's a little bit of the dichotomy that's developed. Corporate business is strong for us.
Stephen, you really kind of neatly encapsulate everything that we're talking about here. What you said is that Hertz is doing really well and sees strong demand coming down the pipe. But you mentioned it, your days at Goldman Sachs, you are obviously in the risk management business as well. Do you think you're being overly cautious sometimes? Do you sometimes have to stop yourself and say, actually, this is better than I anticipated? I know that my kind of inner demons want me to be cautious, but actually what I'm going to do is get this business positioned for stronger growth. How are you balancing these two competing forces in your mind?
Well, it's an interesting question. I mean, I have changed the way we think about managing this business and the way the industry manages it, which it used to be we would determine the fleet we needed or thought we needed, we'd hold fixed on that fleet, and we play with price depending on where demand is. I've changed that completely at Hertz. Now fleet is the lever we pull. I want fleet to be inside the demand curve. So when I see demand that's there, as I think it will be in the summer, we will raise our fleet to meet that opportunity. But you always need to leave yourself with the flexibility that you can modulate fleet. And I think Hertz and rental car companies are good defensive plays with the prospect of a recession in that our assets can move. We can move them between, from, or to markets, and we can buy and sell fleet very quickly, different than planes, different than hotels in how we manage the business.
But Stephen, on the subject of your fleet and the composition of those vehicles, are you on track with your EV plans? Are you going to be able to get 100,000 cars from Tesla?
Well, not only will we get 100,000 cars from Tesla, but we'll get 65,000 from Polestar and 175,000 over the next 5 years from GM. And so I'm quite confident that as we sit here now at 10% of our fleet being electric, we're going to look to get to 25% by the end of next year.
You're talking about quite strong demand. What is happening with the price of your fleet? Now, clearly, you had an issue coming out of the pandemic. Used car prices were incredibly high. All of the major car companies had to deal with that. What's happening now? Can you give me a sense of what is happening with that inventory? It is depreciating. I think I saw a number, 252 per car per month is the depreciation number. Do you expect that number to accelerate or decelerate?
Well, I think in the near term, the depreciation number should stay roughly where it is. Longer term, as we would think there's some decline in overall used car or residual car prices, that depreciation number will come modestly up. But I would tell you that there's an interesting development. So I think on the new car side, the OEMs are certainly producing more than they were a year ago, but nowhere near what they were doing before. And I think that's a function, a bit of supply chain, a bit of trepidation about the economy, and the shift from combustion engine to ICE. Equally on the used car side, and I think this is why in the first quarter we saw prices rise, not come down, is that there's no new supply of used cars when you think about off-lease, i.e. good condition, low mileage cars. The reason is that we're now coming on to the point at which cars that would be coming off lease never went on lease. These are cars that would have been leased out late early 2021. They weren't leased, they weren't produced, and now the used car market is not getting resupplied, and I think that will hold car prices roughly where they are, be stable for us on depreciation, and I think also guide us to a more stable price environment.
And that has a big implication for the inflation data that we all spend so much time watching and watching so carefully. Stephen, that's really useful, really interesting stuff. Thanks for spending some time with us today. We really appreciate it. Stephen Scher, Hertz's CEO. This is Bloomberg. Okay, we're tracking towards the Thursday close. Let's start top down, then we'll go bottom up. Stock 600, fairly flat today, but within that, as ever during earnings season, there's some really interesting stories that are worth digging into. We'll do that within the next hour. The slightly stickier inflation in the GDP number out of the States is giving the dollar a bit of a boost. The euro's a little weaker on the back of that. We're back flirting with the 110 line. We're down by around 0.3%. Then we get into the corporate news. Deutsche Bank, maybe no longer the weakest link. There's a really interesting opinion piece on this. The stock is up by 2.5%. FIC was weak, but actually corporate banking is delivering. Up next, Bobby Kotick, Activision Blizzard CEO, is going to be joining us. Looking forward to this. This is Bloomberg.
About that all day yesterday.
Okay, it is Thursday, the 27th of April. We are nearly done with April. Are we going to sell in May? Well, there's some selling certainly taking place today. The FTSE's down, the DAX is a little bit lower. But again, it's a bottom-up story. The corporate story is where the real action is right now. We're going to dig into some of those corporate stories. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So So the index feels irrelevant right now. There you go. Stock 600 still in the tight range. 463.62. We're up by 0.1%. But then you look at the variation in the corporate reporting story. Barclays up by 5.1% today. The UK consumer is still strong. They're doing well in fixed income trading. The market is rewarding Barclays. The banking story here in Europe feels a little bit more stable. The stock story, though, I think is really interesting when it comes to what is happening in chips. We saw a chart a little bit earlier on from Abigail Doolittle talking about the kind of the macro signal coming out of the chip sector. Well, you get that once again today with ST Microelectronics. That stock, Kaylee, is down by over 8%. European chip stocks a while ago were on a real tear. That has definitely rolled over.
Yeah, well, it is an individual stock story here in the U.S. as well. A lot of earnings have been rolling out, and by and large, they are supporting risk sentiment. The S&P 500 right now up by about 0.8% on some of those earnings stories, but we also are contending with economic data. On the surface, GDP this morning looking weak, but beneath that surface, you see that it was really driven by a pullback in inventories and business investment. Consumer demand, though, still looking quite strong, and will that lead to further inflationary pressures, which we also saw evidence in some of the price data this morning? That is what the bond market is dealing with. The two-year yield up nearly 10 basis points on the day. We are back north of 4% at 4.04 at the moment. As for some of those individual stock stories I mentioned, Meta, of course, is one of a monster move after earnings up 14%. An digital ad spending rebound helped fueling a beat. You have the AI investment as well that the market is excited about. This stock now double what it was worth at the beginning of the year. And then First Republic, of course, a stock that has not doubled, in fact, has seen more than 90% of its value wiped out this year, is attempting a rebound today, only up 8% though. We're still at $6 a share. Remember, it was north of 120 at the start of this year. We are still looking to see if there is a rescue of this bank, and if it comes from the private sector or from the government guy, still an open question.
Yep. Will we have to wait until the weekend? Often these things get done Friday into the weekend in terms of delivering a deal or finding a resolution. Are we going to get that this weekend? Stay tuned. We are certainly continuing to watch what is happening with the European earnings season with a great deal of interest. The index level, nothing happening there. Corporate news. Reporting season really delivering some interesting stock stories, I think. We've been talking to a whole bunch of CEOs across Europe. This is what they've been telling us about the macro environment they're seeing.
We've made a strong start to 2023, top line growth of 10.5%.
It was a very strong quarter for sure.
Really an interesting start of the year with this top line growth of 5.5% at constant exchange rate, and with an EPS growth double digit 11.9%. We have really a strong start in 2023.
The focus is very much to keep our head down and focus on what we do great, which is again focus on drugs and focus on innovation and focus on patients.
There is more inflation coming into our cost base, $1.5 billion incremental in the first half. So costs are not coming down. They're just not going up as quickly as they were.
Some really interesting insights into what is happening there, Kaylee. Look, what I heard there was we are seeing strength. We have a strong top line. Growth is still a big part of our story right now.
Yeah, definitely. And then when we were just hearing the Unilever CEO talking about how costs aren't going down, but they're not going up as quickly, it becomes, again, a question of pricing power, the ability to pass on those higher input costs. And if you are still seeing stronger demand, Guy, it would, in theory, indicate that companies can keep doing that and earnings can hold up.
Yeah, there's a bit of a sort of, there's some interesting sort of stories developing though about whether these companies are using inflation to push up top line too strongly. And I think that's going to be certainly something that we're going to be watching over the next few weeks. Unilever having to push back on that quite strongly today.
Yeah, it's definitely something that we're going to continue to watch because earnings season, of course, is far from over. We are going to continue to get reports after the bell today from big tech. Amazon is on deck. But elsewhere in big tech, the story that has really been dominating headlines over the last 24 hours has been the UK regulator knocking down the $69 billion deal between Microsoft and Activision Blizzard. So on that note, let's go now out to San Francisco, where Bloomberg technology anchor Ed Ledlow is joined by the Activision CEO, Bobby Kotick. Ed, we're going to send it on over to you.
And welcome to our Bloomberg Television and Bloomberg Radio audiences worldwide. We are joined by the Activision Blizzard CEO, Bobby Kotick. Good morning to you, Bobby.
Morning, Ed. Thanks for taking the time to have me.
Thank you for joining the program. We are going to talk about earnings. We're going to talk about video games, which you and I share a passion for in common, but we will...
They're thinking